Okay, we're going to use this video to look in depth at stock options and the taxation of them, and then I'm going to look at a couple of examples from the book of questions just to on some of the topics that tend to confuse some people. So, stock options. We have a timeline and there are 3 events. The 3 events are the grant, the exercise, and the disposition. Now, people use different names for these, but we'll stick with these and see how it goes. Let's look at the cash flows so that we understand what's going on. So first of all, the basics of it. At grant, the company goes to the employee and says, here is a choice. You can buy these things at a future date at this set price. That price is the exercise price. The employee then makes that choice of whether to exercise or not. When they do, they buy the shares. Okay, so let's look at this. At grant, there is no cash flow. At exercise, the employee buys, this is what a lot of people don't understand, shares. So cash leaves the employee and goes either to the company if they're buying treasury shares or into the market if they're buying other shares. Okay? At this disposition, the employee, now the shareholder, okay, so let's make a special note here. This is actually, at this point, they're not an employee, they're a shareholder like anybody else, and they sell the shares. Okay? So there you go. There's the cash flows. Now, it's important to note that there's 2 values that move around. So there's the fair market value, or that, well, one does and one doesn't. The fair market value at grant, the fair market value at exercise, and the fair market value at disposition. And that'll move all over the place according to what the market says that company is worth at any given time. The strike price, or exercise price, okay, so what most people call the exercise price or strike price does not move. Okay, so I'll just represent this and say it's the same. Its value is X at every time. It is set and it never changes. And actually here we should really get rid of this and say no, it doesn't. It's not even relevant. After exercise, the strike price is it's done. Its relevance is finished. Okay, so income inclusion for tax, what happens? Well, at grant, nothing. At exercise, the fair market value at exercise, so this value minus this value is equal to your income inclusion. And at disposition, everything is capital gain or loss. You hope gain, but loss possibly. Okay, so important note, the income inclusion. So that's, I'm being very specific there. Income inclusion. Obviously, capital gains, once they're cut in half, are income inclusions as well. But hopefully you understand the difference of what I'm trying to say there. Now, there's a lot of little glitchy things here with stock options. One, if you are a CPC, you can defer the income inclusion. So whatever you get this, you can defer this until when? Until disposition. Okay, that's only if you're a CCPC. It used to be that you could do that if you were a public company as well, but that is no longer so, and I've noted that in the slides. Okay, also, there's kind of another thing to note here. Also, there is a Division C deduction available, okay, to be taken basically against this income inclusion. Okay, and what's the deduction equal to? Well, it's equal to half of the income inclusion. So half of this number. So half of that is equal to your Division C deduction. Okay, how can you get it? Well, you can get it taken or available, I guess, if one. So these are 2 conditions. If the fair market value at grant is less than or equal to the exercise price. Okay, so another way to say that is the options are not in the money when you exercise. Okay, so that's really the only one that's available. And then, so I shouldn't really number these. I should just say, yeah, they're taken if, okay, that's the condition. If you are a CCPC, there's another way you can do that if you hold for 2 years. Okay, so if the lag between income inclusion and, between exercise and disposition is more than 2 years, then if you're a CCPC, you can also get this Division C deduction. Okay, so those are the rules, hopefully somewhat clear, and you can go to the slides too for summary. Now what I'm going to do is I'm going to look at 2 problems. The first one, or their exercises, actually exercise 3.9. So let me bring this in here. Pictures. Sorry, I should get this done ahead of time. Okay, insert. Okay, so there's the question. I'll leave it for you. We don't need to spend time on it on the reading, because you can do that. So here is the timeline. Here's grant. Here's exercise. Here's disposition. And all we want to do is figure out basically tax implications. Okay, so the fair market value at grant is equal to $1.50. The exercise price, is set in the contract at $1. The fair market value at exercise is equal to $3. And then looking ahead, so actually let's get the facts down first. So when she sells a year later, it is equal to $6. The proceeds of disposition. She actually obviously has 50,000 shares. I'm doing this on 1 share. The ACB will be equal to her $3, as we'll talk about, and so her gain pre-income inclusion, pre-50% is $3. Okay, what is her income inclusion at exercise? Well, it's equal to $2, which is simply 3 minus 1. Okay, so hopefully that's fairly straightforward. The way I think about this is she got something that was worth $3, she paid $1, the company, because she's an employee, made up the difference and gave her another $2. Does she get the Division C deduction? Okay, so let's take a look. So remember, this is to reduce this $2. Is it available to her? Well, it is a CCPC in the question, so we have to know, did she hold for 2 years? And the answer is no. She didn't. So she exercised in year 5, sold in year 6. That's not 2 years. So she doesn't get the special treatment. Does she get the other treatment? Was fair market value at grant less than or equal to the exercise price? Question. Okay, so fair market value at grant was $1.50. Exercise price was $1. No, that sign goes the wrong way. So no, she does not get the Division C deduction. Okay, so that's how that question works out. Okay, now I'm going to jump here quickly and look at another question, and that question is going to be the very next one, actually, exercise 3.10. But I want to look at a standby charge, or a operating cost benefit. Sorry, automobile benefit, because I think it will be useful to a lot of people. Okay, so this is automobile. This is exercise 3.10. Okay, so there's the question. Again, I won't spend any time on the question itself. Reading it, but let's just take a look at what we're given. So it's a guy, he has full use of an employer-owned car. Okay, so what we have to do is figure out standby charge and operating cost benefit under 2 scenarios. So for scenario A, his business kilometers are 10, his total kilometers are 22. Okay, that is less than 50% business use. Okay, so what that means is that his A over B for standby charge is set to 1. Okay, if you're not familiar with this, you'll get familiar with it. It also means he has, it also means no option on operating costs. Okay, and we'll look at that, what that means. Okay, the other thing to note here is the capital cost allowance to be claimed by the employer is irrelevant. Okay, that tells us they're getting a deduction on the car, and it's kind of nice to refer back to it and see how it matches up with what we're going to include in his income, but it's irrelevant to our calculations. Okay, so what is relevant to our calculations? Well, his standby charge is pretty straightforward. 1 times 2% times the cost. Now be careful here. I actually read this wrong when I did it myself the first time. It includes the HST. So including HST, we put it, whatever they paid, put it all in, times number of months. That gives us $4,800 standby charge. Okay, his operating cost benefit is equal to 26 cents times personal kilometers. Okay, and he has no option here. So we noted there's no option. If you want to know what the option is, you'll see it in part B. Okay, so that's $31.20. It tells us here that he reimbursed the company. Okay, so that means he paid off some of this, or paid back, I guess is a better way to say it, paid back some of this. So he's left with $61.20 in benefit. Okay, so that goes on his tax return, and he pays tax on that. So you look at that and you go, okay, well, how does it line up? Well, the CCA lined up okay. So in this case, it actually looks not that bad. It does not always work out that way, I assure you. Okay, B. Part B just says, changes it slightly. So now we have 20 over 32, which is greater than 50%. So that means he can have his A over B and he can have his option. Okay, so standby charge is now equal to the, personal kilometers over the amount set by the Act, 1667 times 12. Okay, so that's just that. Okay, so that's the A over B times 2% times $20,000 times 12 months. That will give us $28.79. Okay, so I mean it's not really in the question, but compare that to this, and significantly smaller. Okay, so operating cost. This is for what they are paying for him. So option 1 is 26 cents times 12, which is $31.20. Option 2 is 50% of what you just calculated, $28.79, which in this case is $14.40. That's smaller, so we're going to take that. Okay, he still reimbursed $1,800. Okay, so he gets to fully, even though that's more than the operating cost, that's not relevant at all. It can be reimbursement for the standby charge as well, and so he's left paying tax on 25 benefit. Okay, there's an extra thing in there. Okay, so there's his benefit, 25. So almost $4,000, $3,500 less than in the first example. Okay, so hopefully that helps people understand what the standby charge is and how it works.